Right now, somewhere in a small apartment in Ohio, a 26-year-old is staring at a phone screen at 2 in the morning. The numbers on the screen are red. Then they're green. Then red again. His hands are shaking, not because he's scared, but because for the first time in his life, he feels like he's finally inside the game everyone else has been playing without him. This is 2026. And something has changed in the way America trades money. Because the truth is, this isn't just about Bitcoin anymore. It's not just about the stock market either. It's about a war being fought quietly, every single day, between two forces that have existed since the beginning of human civilization, fear and greed. Except now, that war has a new battlefield. Phones. Apps. Notifications. And millions of ordinary people who suddenly believe they can outsmart Wall Street from their bedroom. But here's where the story gets interesting. Because most people watching this have no idea what's actually happening behind the numbers. They see the headlines. Bitcoin surges, stocks rally, markets crash, but nobody explains why. Nobody explains what's really driving this chaos. And that's exactly why so many people lose money without ever understanding what hit them. So let's go back. Not years. Just months. Because what happened at the start of 2026 changed everything. For the first time in modern history, retail investors, meaning regular people, not big banks, started controlling a massive percentage of daily trading volume in the US stock market. Think about that for a second. The average teacher, nurse, delivery driver, or college student now has more influence on short-term market movement than most professional fund managers. That should sound empowering. And in some ways, it is. But there was one problem. Power without understanding is dangerous. And Wall Street knows this better than anyone. Because while millions of new traders were opening accounts, learning terms like candlestick patterns and resistance levels from 15-second videos, something else was happening in the background. Artificial intelligence systems, built by hedge funds with billions of dollars, were analyzing that exact same retail behavior in real time. Predicting it. Sometimes even exploiting it. It's like a chess game where one player has been playing for 40 years, and the other player just learned the rules yesterday, except now the beginner has access to leverage, trading bots, and unlimited confidence from social media. What almost nobody realizes is that this collision, between human emotion and machine precision, is exactly what's creating the wild swings we've seen in both Bitcoin and the stock market throughout 2026. Let's talk about Bitcoin first. Because its story alone feels like something out of a movie. At the start of the year, Bitcoin wasn't just a cryptocurrency anymore. It had become something bigger, a symbol. A symbol of rebellion against traditional banks. A symbol of hope for people who felt left behind by the system. But also, a symbol of extreme risk for anyone chasing quick riches without understanding what they were holding. Institutional money, real corporations, real governments, started treating Bitcoin less like a gamble and more like digital gold. Some countries began exploring it as part of national reserves. Some major companies added it to their balance sheets. That gave Bitcoin a kind of legitimacy it never had in its earlier years. But then something happened that nobody expected. Volatility didn't disappear. It got worse. Because now, instead of just retail traders moving the price with excitement or panic, massive institutional funds were entering and exiting positions worth billions of dollars within hours. When they buy, the price can rocket upward violently. When they sell, it can crash just as fast. And regular investors, watching the chart in real time, feel like they're on a roller coaster with no seatbelt. This is where psychology becomes just as important as economics. Because the biggest danger in 2026 isn't the market itself, it's the emotional trap it creates. Fear of missing out pulls people in at the worst possible moments. Panic pushes them out at the worst possible moments too. It's the same story that's been repeating throughout financial history, just with faster internet and shinier apps. Now let's shift to the stock market. Because this is where the story becomes even more layered. Wall Street in 2026 doesn't look like the Wall Street from 10 years ago. Artificial intelligence isn't just assisting trading decisions anymore. In many firms, it's making them. Algorithms process news, social media sentiment, and even human tone of voice from earnings calls within milliseconds. Decisions that used to take human analysts hours now happen in less time than it takes you to blink. At this point, everyone expected traditional investing wisdom to still apply. Buy quality companies, hold for the long term, avoid emotional decisions. And in many ways, that advice still holds true for people building real wealth over time. But there's a growing gap between two types of people in this new economy. One group is trading. The other is investing. And the differences between them have never been more dramatic than they are right now. Trading, especially short-term trading fueled by social media hype, has become almost like digital gambling for a large percentage of young Americans. Stocks tied to viral trends can spike overnight because of a single video, then crash just as fast once the excitement fades. It feels thrilling. It feels powerful. But statistically, most short-term traders lose money over time, not because they're unintelligent, but because the system is designed for speed and emotion, not patience. Meanwhile, quietly, without the same excitement or attention, long-term investors, the ones who understand diversification, patience, and risk management, continue building wealth slowly. Not through miracle overnight gains, but through consistency across years, sometimes decades. That wasn't even the biggest surprise of 2026. Because as more people entered the markets, something unexpected happened to the American economy itself. The stock market started reacting not just to company earnings or interest rates, but to public emotion. Social sentiment became a measurable economic force. A viral tweet, a controversial interview, even an AI-generated rumor could move billions of dollars within hours before being corrected or debunked. This created a strange new reality. Truth and financial value became more disconnected than ever before, at least in the short term. And this is where everything became interesting. Because in the middle of all this noise, crypto swings, stock volatility, AI-driven trading, social media hype, something incredibly human started happening. People began searching for stability. Not excitement. Not overnight riches. Stability. Financial educators saw a massive rise in interest around long-term investing strategies, retirement accounts, index funds, and basic financial literacy. It's almost poetic. In a year defined by chaos and speed, more Americans started asking the same simple question their grandparents once asked: how do I build wealth slowly and safely? Because the real story had just begun to reveal itself. The truth about trading and investing in 2026 isn't about predicting the next Bitcoin explosion or timing the perfect stock trade. It's about understanding a fundamental truth that never changes, no matter how advanced technology becomes. Markets reward patience, discipline, and knowledge, not emotion. Yes, some people will get lucky. Some viral trade will make headlines. Some story will go viral about a college student who turned $500 into $50,000. But for every story like that, there are countless untold stories of people who lost far more, quietly, without ever making the news. This isn't meant to scare you away from participating in these markets. It's meant to prepare you. Because the opportunity is real. Bitcoin, stocks, modern investing tools, they've opened doors that didn't exist for previous generations. Never before have ordinary people had this much access to global markets, real-time information, and powerful financial tools. But access without education is like being handed the keys to a race car without ever learning how to drive. So maybe the most important lesson from all of this isn't about charts, algorithms, or artificial intelligence. It's about human behavior. About understanding yourself before you understand the market. Because the market doesn't care about your emotions, but your emotions will absolutely determine your results. That trader in Ohio, staring at his screen at 2 in the morning. He's not alone. Millions of people across America are living that same moment right now, caught between fear and opportunity, trying to figure out where they fit in this new financial world. And maybe that's the real story of 2026. Not Bitcoin. Not the stock market. But an entire generation learning, in real time, what it truly means to build wealth in a world that never stops moving. Because in the end, the market will always rise and fall. The only question that really matters is who you become while you're watching it happen.